7 men went to work at a silver mine in Sinaloa, Mexico on January 23rd, and they clocked in like any other morning. They checked their equipment, descended into the tunnels, and never came home. Their bodies were found over the following weeks, confirmed dead, murdered by cartel members, not caught in crossfire, not collateral damage, targeted, abducted from their workplace, and executed. 7 employees of Vizsla Silver at the PUNITIVE project. 7 families destroyed, 7 funerals, and 7 reasons why cheap silver is over forever. Because what happened to those 7 men is not an isolated incident. It is the beginning of a systemic collapse of the world's most important silver supply chain. Mexico produces 28% of all silver mined on Earth, nearly half of all primary silver production. More silver comes from Mexican ground than from any other country, by a factor of 2. When Mexico's silver production goes offline, it cannot be replaced. There is no backup, there is no alternative, there is no other country with the geological endowment to fill the gap. And Mexico's silver production is going offline right now, in real time, while the world needs more silver than at any point in human history. Let me show you how bad this has gotten, because the scale of this crisis is being buried beneath market noise about paper prices and contract mechanics. February 2026, the Jalisco New Generation Cartel lost its leader, Necio Oguera Cervantes, known as El Meno, one of the most powerful drug lords in Mexican history. His death created a power vacuum that detonated across 22 Mexican states simultaneously. Not a gradual unraveling, an explosion. Every subcommander, every regional boss, every allied faction, all fighting for control of territories that generate billions in drug revenue. The mines are in those territories. Silver does not choose convenient locations to deposit itself over millions of years. It forms where geology dictates. And Mexican geology deposited the richest silver veins on Earth directly underneath cartel-controlled territory. Sinaloa, Durango, Zacatecas, Chihuahua. The silver belt runs through the exact regions where cartel violence is now at its most extreme. Here is what has happened since El Meno's death. Armed blockades across highway corridors used to transport silver concentrate. Military-grade weapons deployed at roadblocks within miles of active mining operations. Direct targeting of mining personnel for kidnapping and ransom. Armed intrusions onto mine properties. Theft of equipment, fuel, and explosives. Because mining operations store the same ammonium nitrate that cartels use in their territorial warfare. The result is cascading through the global silver supply chain in ways that most analysts have not even begun to quantify. Fresnillo, the world's single largest primary silver producer, headquartered in Mexico City with operations across the silver belt. Their 2026 production guidance has been slashed from over 50 million ounces down to 42 to 46.5 million, a minimum cut of 4 million ounces. But that guidance was issued before the latest escalation, before the Vizsla murders, before the armed blockades spread to 22 states. Mining executives are privately suggesting Fresnillo's actual 2026 output could fall below 40 million. That would be a 10 million ounce decline from previous expectations. From one company, the biggest one. First Majestic Silver, stock down 12%. Operations concentrated in Mexico's most violent regions. Cost expansion is eating margins despite record silver prices, because security expenditures have become the single largest line item in their operating budget. Armed guards, armored vehicles, helicopter transport for personnel, insurance premiums that have tripled in 6 months. These costs add $15 to $20 per ounce to their all-in sustaining cost. At $85 silver, they are profitable. At $68, CME Group's bearish target, they are operating at a loss after security costs. The bearish price targets being published by Wall Street analysts physically cannot exist if Mexican mining costs are $15 to $20 higher than their models assume. Pan American Silver, double-digit stock decline. They just discovered new high-grade veins at La Colorada, excellent geological news. Completely irrelevant to 2026 supply, because developing those veins takes years. You cannot drill, blast, extract, process, and refine new silver veins in months. The discovery makes 2028 or 2029 supply better. It does nothing for the 2026 deficit. Vizsla Silver's market cap lost $76 million, and the PUNITIVE project in Sinaloa is facing potential suspension. Not because the silver ran out, because the workers are dead and nobody will replace them. Geologists who specialize in Mexican silver deposits are updating their resumes and looking for work in Canada, Australia, anywhere that is not Mexico. The human capital that makes Mexican mining function is fleeing the country. Now let me quantify what this means for the global silver market, because the numbers are devastating. Mexico produced approximately 222 million ounces of silver in 2024, 28% of the 830 million ounce global total. If Mexican production declines 15% in 2026 due to the security crisis, that is 30 million ounces removed from global supply. 30 million ounces in a market already running a 67 million ounce annual deficit. The deficit doubles to 100 million ounces or more. But 15% may be conservative because the violence is concentrated in exactly the regions where the highest grade deposits are located. Sinaloa, Durango, Zacatecas. These three states produce approximately 60% of Mexico's silver. If production in these three states declines 30% while other Mexican states maintain output, the national decline would be approximately 18%. That is 36 million ounces added to the existing 67 million ounce deficit. Total deficit, 103 million ounces in a single year. 103 million ounces of deficit against COMEX registered inventory of 81 million. The annual deficit would exceed the entire deliverable inventory of the Western world's primary silver exchange. In 12 months, the deficit consumes more silver than COMEX can deliver. And the deficit is cumulative. It does not reset at year-end, it compounds. 820 million ounces already consumed beyond production since 2021. Add another 100 million in 2026. That's 920 million by December. Add the deficit from 2027 when no new mine capacity comes online, and you are over 1 billion ounces of cumulative deficit by the end of 2027. 1 billion ounces consumed and not replaced. Embedded in solar panels, iPhones, missile guidance systems, and nuclear control rods. Not sitting in a vault waiting to come back to market. Gone, permanently. Now here is the detail that turns the Mexico crisis from a supply story into a price story: transportation insurance. This is the mechanism that directly translates cartel violence into higher silver prices at every level of the supply chain. When a silver mine produces concentrate, it must be transported to a refinery. In Mexico, that means driving through cartel-controlled territory. Insurance companies assess the risk of that journey and price their policies accordingly. When the risk includes armed highway blockades, cartel ambushes, and the murder of mining personnel, insurance premiums skyrocket. As of March 2026, several major insurance underwriters have stopped offering coverage for silver shipments in Sinaloa and parts of Durango entirely. Not increased premiums, stopped offering coverage. When you cannot insure a silver shipment, you cannot ship it. Banks will not finance uninsured cargo, and refineries will not accept uninsured deliveries because they bear the liability if the shipment is stolen. The entire logistics chain seizes. The silver that Mexico's mines produce is becoming stranded at the mine site. Physically mined, but commercially unavailable. This creates a bizarre situation where Mexico's reported production numbers show mining continuing, but the actual ounces reaching refineries are significantly lower than reported production. The discrepancy between mined silver and delivered silver is the hidden supply shock. Mining companies report production based on what comes out of the ground. The market models supply based on those reported numbers. But the market actually receives only the silver that survives the journey from mine to refinery to exchange. When transportation insurance collapses, the gap between reported production and actual delivered supply widens dramatically. Nobody is modeling this gap. Not JP Morgan at their $81 average target, not CME Group at their $68 bear case, not Bank of America at their $309 bull case. Their supply models use reported mine production figures, not delivered refined ounces. The actual supply reaching the market is lower than every model assumes, which means the actual deficit is larger than every model projects. Now connect Mexico to the other supply crises hitting simultaneously, because the Mexican collapse is not happening in isolation. It is happening alongside 4 other supply destructions, all converging in the same quarter. Supply destruction 2, nitric acid shortage. The chemical required to refine silver scrap has become unavailable due to Chinese export restrictions, and recycling normally contributes 200 million ounces annually. That supply is contracting. The one source of flexible supply that could offset the mining shortfall is chemically unable to function. Supply destruction 3, Shanghai inventory blackout. China controls 70% of global silver refining. Shanghai has stopped reporting inventory, and premiums at $12 to $25 suggest stocks near zero. The world's largest silver processing nation has gone dark and is hoarding. Supply destruction 4, Strait of Hormuz closure. 21% of silver-bearing container shipments from Dubai re-export hubs have been diverted to the Cape of Good Hope route, adding 9 to 11 days to delivery. War risk insurance is spiking, and the logistics pipeline for silver moving from east to west has been stretched beyond functional limits. Supply destruction 5, military consumption 500 ounces per Tomahawk missile. Active combat operations against Iran are expanding to Indian Ocean submarine warfare, and silver is being detonated daily and permanently removed from global supply. Not recycled, vaporized. 5 simultaneous supply destructions. Mining collapse from cartel violence, recycling collapse from chemical shortage, refining opacity from Chinese hoarding, logistics disruption from naval warfare, physical destruction from missile consumption. All 5 happening in the same quarter, against 820 million ounces of cumulative deficit, against COMEX registered at 81 million ounces. Against demand that is expanding from solar, EVs, AI, nuclear, defense, and investment simultaneously, $100 silver is not a prediction in this environment. It is arithmetic. When supply contracts by 30 to 50 million ounces from Mexico alone, when recycling contracts instead of growing, when Chinese refining capacity is redirected domestically, when all of that hits a market already in structural deficit, the price must rise. It must rise to a level that either destroys enough demand to restore balance or incentivizes enough new supply to fill the gap. Demand destruction at $100. Does the Pentagon stop buying silver for missile guidance because it costs $100 instead of $85? No. Does the solar industry stop installing panels because silver paste costs 18% more? Installations are up 15% despite record prices. The demand is inelastic at $100. It is inelastic at $150. It might become elastic at $200 for some industrial applications, but defense, solar, or nuclear never become elastic because there is no substitute for silver in those applications. New supply at $100. Does $100 silver bring new mines online? Not for 7 to 12 years. The geology has to be discovered, permitted, financed, constructed, and commissioned. Does $100 silver increase Mexican production? Not while cartel members are murdering mine workers and insurance companies refuse to cover shipments. Does $100 silver fix the nitric acid shortage? Not while China maintains export restrictions. $100 silver does not restore balance. It is the minimum price at which the market acknowledges the severity of the supply crisis. The actual balancing price, where supply meets demand, is higher. How much higher depends on whether the Mexico crisis deepens, whether the Iran conflict expands further, whether China continues hoarding, and whether nuclear demand scales as projected. Bank of America's $309 target, Citigroup's $150 to $173 monthly target, William Middlecoup's $500 projection. These are not fantasy numbers from internet speculators. These are institutional targets from research departments managing trillions of dollars. They see the same data I just showed you. 7 dead miners, collapsed insurance coverage, stranded production, chemical supply failure, Chinese hoarding, military consumption, and a deficit that has consumed 1 billion ounces with no mechanism to replenish it. Every analyst who publishes a silver target below $100 in this environment is either ignorant of the Mexico data, deliberately ignoring it, or financially conflicted, because they hold short positions that benefit from lower prices. There is no fourth option. The Mexico supply destruction alone, independent of every other factor, guarantees that current production cannot meet current demand. The deficit is structurally unfillable at current prices. The price must rise until demand is rationed or supply is created, and neither happens below $100. 7 men went to work at a silver mine and never came home. Their deaths are a tragedy, but their deaths also represent the moment that cheap silver became a mathematical impossibility. Because those 7 deaths stopped other workers from showing up, which stopped production from flowing, which stopped refined silver from reaching the market, which widened a deficit that was already the largest in modern history, which made the 81 million ounces at COMEX the last accessible pool of cheap silver on Earth, which started a countdown that has 34 days remaining before that pool runs dry. 34 days, 7 deaths, 5 simultaneous supply destructions, 820 million ounces of cumulative deficit. $100 silver is not the ceiling. It is the floor being built right now by forces that no margin hike, no algorithm, and no bearish analyst report can stop. Verify the Vizsla deaths at mining.com. Verify Fresnillo's guidance at their investor relations page. Verify the insurance collapse at Pinnacle Digest's Mexico Silver War report. Verify the nitric acid crisis at Phoenix Refining. Verify COMEX registered at CME Group. Verify Shanghai premiums at SGE. Verify military silver consumption and defense procurement records. And verify Bank of America's target in their published research. Cheap silver is over. Mexico guaranteed it, the arithmetic confirmed it, and the countdown is running. See you Monday.